This morning, we're looking at whether the UK's recession will be short-lived because retail sales data has picked up massively. We're going to find out a little bit more about that. And then the trade in Takeout today is going to be what is a market maker, because there's so much misinformation as to what a market maker does and who they are. But first, make sure you like and subscribe to the channel so that I can pop up in your YouTube feed every single day to improve your trading edge. So in contrast to yesterday's really, really bad GDP data for Q4, we're looking at retail sales data today, and it's a complete 180 on where we were. You know, we can see here that the month-on-month number was 3.4%. Versus the expected of 1.5%. Previous, though, it was negative 3.2%, which sort of shows you why there was such bad GDP growth in Q4. We just weren't buying anything, but this month we are. So I'm not too sure what's happened there, but I will investigate, and I'll probably get back to you about that on Monday, just to see whether there's any caveats there. But really, this is quite astounding. And, you know, the year-on-year number, 0.7%, expected negative 1.4%. The previous was negative 2.4%. In my view, this means that we're out of recession already, based on, you know, how we're looking at the December figure versus now the January and hopefully moving forward figure. So really, really good numbers out of the UK there. And we can take a look quickly at how the pound versus the dollar has reacted on a short-term basis. So let me just get rid of some of these. You can see that it's ticked up a little bit. It's liked it. It ticked back through 1.26 very, very briefly. You can see here. This is basically where the news was, and we've just now traded just above 1.26, now faded it a tiny bit, but you can see where the trajectory has sort of gone with this initial move. My thoughts is that if we do start to print, you know, better data than last month, it kind of, you know, considers that Q4 number as a bit of a blip. Obviously, Q3 as well matters, but that trend is reversing. Basically, the trend of bad growth is reversing. So positive signs there for sterling. The Bank of England are probably in a whole world of confusion now, though. So as I said yesterday, it'll be very, very interesting as to how the votes start to shift for the next meeting, because this mixture of data and relying on backward-looking data to make a forward prognosis is really, really sort of a folly. It's difficult to do, you know. So the Bank of England are going to be looking at data very, very closely here. And do bear in mind that a lot of the negative print yesterday was due to services. It wasn't due to manufacturing. But the bottom line here is that the retail sales number is showing that there is a relatively strong consumer to where we were even just a month ago. Okay, so the January retail sales number is very strong. Now, perhaps what has happened here is that people had bought Christmas presents way earlier. You know, that could be something that has happened. But, you know, I haven't delved into the numbers specifically yet. I'm going to do that later today and get back to you on Monday about it. Because I think that the UK's situation is kind of a special one in that Europe isn't doing too well. The UK obviously hasn't done too well there. But it will be interesting now to see whether there's a specific divergence in GDP growth that can occur now that, you know, the UK is out of the European Union. So interesting times. Where do I think cable will go? Well, I don't have a view at the moment. I really, really don't have a view. You could argue that we've got a bit of a broader level here that we could probably burst above. If we get some momentum through here, then we trade back up to 1.269, where we saw the US CPI number come out at. But overall, no real view. I think you could argue that there's a bit of an over-under pattern that's playing out right here. You know, a bit of a head and shoulders. If we look again at, let's call it this level, you know, there's a nice little range here. So I'd argue below here, take it back down to the lows. Above here, take it back to the highs. It's 2024, and I'm still seeing quite a lot of misinformation as to what market makers do, who they are, and whether they want to take retail traders' stops. It's quite bizarre that this sort of myth keeps perpetuating. And I know plenty of market makers, people that are at firms who are just facilitating their jobs. They're not special people. They're not some shady cabal. And so it's quite bizarre to me when I see many retail traders still thinking that market makers are against them. They're running their stops. There's a couple of things to take from this. So firstly, what is a market maker? Well, their job is to supply liquidity at prices where the market generally isn't, supplying prices at, to ensure that there's no massive price jumps. Now, how is this beneficial to traders? Well, it reduces costs effectively. The market maker then also just makes money from the spread. Many seem to misconstrue this with what a retail brokerage does, in that a retail brokerage runs a B book. That is a form of market making, absolutely. However, it is a form of market making with a specific business goal in mind, which is that most retail traders, no matter what they do, whether you trade on an ECN, SDP, doesn't matter, they will lose money. So it's very similar to a bookmaker in that sense, because most people understand, or the bookmaker at least understands, that if they have an edge over time in their favor, they're most likely going to make money, because gamblers are gamblers. There's no systematic way of gambling for many people. They just gamble based on what their feelings are. Very similar to trading. Many retail traders are just out there pressing bid and offer based on their feelings, rather than any kind of systemization of risk, any kind of systemization of entering, managing trades, etc., etc. And at the end of the day, what a market maker wants to do is they want to supply a two-way price, because the better they can do that and the tighter they can quote, the more they get hit, which means that they can then make the spread up more. They can generate more revenue for their desk, for themselves, get their bonus, and, basically pay the mortgage, I guess. So there's a hell of a lot of misinformation. I think market makers are used as a bit of a bogeyman purely because people like to absolve themselves of responsibility. They like to think that there's some shady thing going on that means that, oh, yeah, it's not my fault, it's out of my hands. Kind of like in a religious sense, if you like. So market makers don't want to hunt your stops. They don't care about that. The problem is that you've put your stop in a rubbish place, which is why I always talk about objective risk management rather than chucking a stop above a high or below a low.